Okay, hi. So this video is going to go over the closing process. So the closing process is the last step in the accounting cycle. We've already made our adjustments and we've already prepared our financial statements. So now we're ready to get ready for the next period. So it's just like a scoreboard after a football game. You zero out the scores to start the next game. So likewise, we want to zero out some of our accounts to start the next period. So the ones that we want to zero out are called our temporary accounts. These are the only accounts that go back down to zero for the next period. We call these temporary accounts. The remaining accounts that you see here are called permanent accounts because they don't close at the end of each period. Their balances remain indefinitely. So the ones that we are going to be concentrating on are in the yellow and they're called temporary accounts. So when we say that we want to close them, just like a scoreboard, we want to get their balances down to zero. So we're going to do this in two steps. The first step is said to be close revenues and expenses to capital. And the second step is close drawing to capital. So those are the two steps. And when we say the word close, we simply mean get the balance to zero. So let's do step one, close revenues. So if I look up here, I have two revenue accounts, $30,000 and $6,000. If I want to make these balances be zero, I debit fees earned for $30,000 and that will get my balance to zero. I debit interest revenue for $6,000 and that will get that balance down to zero. I have zeroed out fees earned and interest revenue. Next, I want to close expenses. So right now, salary expense has a debit of $5,000. To get that balance to zero, I can credit salary expense. Right now, rent expense has a debit of $4,000. I can credit it for $4,000 to get it to balance, or to get it to zero. Okay, the next step says close it to capital. This means transfer these balances to my capital account. So right now, I have my revenues and my expenses. And if I add up my debits, I have $36,000 in debits. And of course, we subtract out our credits because debit and credit. So I have $9,000 in credits. So what I'm really sitting with is a net income of $27,000. That's because I have $36,000 in revenue and I have $9,000 in expense. So this really represents net income, which is what I'm trying to transfer to capital. All right, so what I'm going to do is I'm going to transfer this to capital. And I need to see if I need it to be a debit or a credit. My debits are 36. I need my credits to also be 36. So if I put it on the credit side, my debits will equal my credits for this entry. Another way to know that you needed it on your credit side is that capital has a normal credit balance. Net income increases capital. So if we credit capital, that is a positive impact. In a moment, we'll see if we had net loss, it would actually be a debit to capital because a net loss decreases capital. But for now, let's go on to the second step, close drawings to capital. Here's my drawing account. Right now it has a debit balance, so I need to credit drawing to make it be zero. That will be and I need to close it to capital. So I will debit capital because drawing makes capital go down, so this makes sense that I would need to debit capital for that drawing amount. All right, and that completes my journal entry. I would then post this to my ledger and it would update my accounts. I would be left with zero in the temporary accounts. I would be left with zero in drawing, fees earned, interest revenue, salary expense, and rent expense. I would have a new updated amount in capital. So right now I have capital being the beginning balance, which starts with a credit, which is a positive capital number. $131,000. I look and see what I've done here, so I've credited it for $27,000, which represented net income. Then I debited it for $1,000, which represented my drawing. So my new updated capital account would be $131,000 plus $27,000 minus $1,000. So my new updated capital is $157,000. So we have just one more trial balance to prepare, which is called the post-closing trial balance. And here's how it would work. It's going to start with the same numbers as our adjusted trial balance, but then we're going to update them for what we've just done. So all these numbers stay the same except for capital. Capital becomes $157,000. All these numbers get zeroed out because we have zeroed them out. And we can see that we are in balance because all of those numbers actually transferred up here to capital. And here's a little hint. If they're zero, we don't even have to include them. So we can actually just have a shorter trial balance. This one is now called post-closing trial balance. And I'll do a separate video to show the small change that would happen if we were in a net loss situation.